For those of us who've been in the business a while, there's an element of familiarity about this, not only from the bank failure wave that followed the global financial crisis, but even going all the way back to the S&L crisis in the late 80s and early 90s. Given all of those past circumstances and taking the events of the last few days into account, I'd like to throw it out to the panel and based on what we've seen before when banking institutions are under pressure, under the kind of pressure we've seen over the last few days, what can we expect from a D&O perspective, particularly from a D&O claims standpoint? So I'll just throw that out to the panel and ask you to kick it off so that we can explore these topics further.
Is that just to any of us, Kevin?
Sure, Chris. But you've spoken first, so why don't you go ahead and
so now
lead
I'm stuck with it. Okay.
Yeah.
I mean, it's so hard to predict how these things are going to play out at such an early stage. So I think we all have to be, kind of humble and cautious about all of that. But I think I can probably speak for Bill and Yera that as claims people who've been in this for a while, we tend to be pretty jaded and pessimistic. So I think we can probably expect, certainly for the financial institutions that have been impacted, a lot of claims. There are going to be a lot of unhappy constituents, whether it's shareholders, bondholders, customers that have made deposits. I think we're going to, it looks like in the US at least, and maybe the UK, that depositors are going to be made whole by the regulators. But to the extent that that isn't always the case, then another unhappy group.
In terms of,
there's someone at Inigo.
How you see, the economics filter through.
There we go. Thank you. So I think, I think we're just going to see a lot of different constituents. There'll be lawsuits. The FDIC is a pretty aggressive litigator and is very happy to go after insurance proceeds in particular. So I think there's going to be a lot of groups, retaining lawyers and basically fighting over the proceeds of the D&O programs that, in all cases are not likely to be sufficient to cover all the losses. So it'll be a challenging time.
Yera, Bill, do you have any thoughts on what Chris has said?
I think the banking industry is fundamentally a game of trust and confidence, and I think they know that, and so they will rally to try to assist each other so that there isn't a big banking collapse like we've seen previously. At the same time, the plaintiffs are savvy and they're watching all of this go down. And I agree with Chris that there will be claims, and there are going to be multiple parties that are trying to attach to insurance proceeds. But I think the difference now versus back in the 2008 financial crisis is that we're not going to be waiting to see what unfolds, that all the parties from the plaintiffs to defense counsel to the regulators to the insurers are going to be on top of their game, watching and acting quickly.
Yeah, I think sort of goes along the same line as Chris and Yera. There'll be a lot of finger pointing. The FDIC probably in the forefront of that, but as we've already seen, shareholder plaintiffs are out there bringing suits against SVB and Signature. The FDIC is an aggressive party to litigate against. In fact, I'm still dealing with one claim from the 2008 financial crisis with the FDIC 15-ish years later. So I think, while the number of banks that fail may still be a small amount, and, hopefully no further than what we've seen so far, I do think that, we will see some claims, we'll see some insurance proceeds get paid out for sure, and probably most of what's in the towers. And then the other point, just more generally, is, what does this do to the trust in the financial and banking systems among, depositors, borrowers, and whatnot? Does it give rise to, additional unbanked people out there in the world as that number has grown over the years, just with sort of distrust in the financial system?
All three of you mentioned the FDIC, and I thought that was interesting. It's the first thing I think of when we start talking about banking problems. And there have been 2 failed banks so far. But if we're going to get into extensive claims involving the FDIC, that implies more failed banks. In thinking about that possibility, especially in light of the way things unfolded in the global financial crisis, and even going all the way back to the S&L crisis, there's some important differences between at least where we are now and what unfolded before. That those prior waves of bank claims usually centered on the lending function of banks, loans to one borrower problems, getting overextended in questionable speculative real estate investments and so on. But the problem at SVB, and to a lesser extent at Signature Bank, there were treasury issues. They were very different kinds of issues. Do you think that makes a difference in the kinds of lawsuits we might see, and even for the possibility that there might or might not be further bank failures?
Yeah, I think that's a very helpful fact, in that I think it makes it gives the regulators a greater likelihood of holding off a bigger crisis, a systemic crisis, because I don't think it's going to be as expensive to fix this one, right? In the 2008 kind of mortgage triggered meltdown, the assets were just, were garbage basically. So, the losses were massive. I think here it's really just more of a timing and liquidity issue, where the underlying assets, they've had to mark down the bonds as a paper loss, which becomes a real loss if they have to sell them if there's a run on the bank. But if you can hold off the run on the bank, those assets, ultimately, if they hold them to maturity, they'll get 100% of their value back. So I think it is more containable because of that. So the hope is that if the customers can sort of avoid panic and further runs on the many other banks that have a lot of heavy depositors, then hopefully they can hold off the crisis. But to the extent that shareholders are wiped out, they're still going to sue.
Yeah. Bill or Yera, further thoughts on that?
I think a distinguishing factor that we have this time is the social media aspect of it, which we didn't have last time. And that's an unknown. So if there are more banks that fail, whether they're small community banks or if it's a larger bank that goes into crisis, what is the impact of social media? And I don't think you can underestimate that. And so I think the regulators will be watching what happens from a social media event, and we will see what transpires as a result. And I think that's a little bit of uncharted territory. So it's almost impossible to foresee the future. But what we do know is that the plaintiffs are watching it. The regulators will be active. The banking industry will try to save itself. But as Chris said earlier, or I don't know if it was Bill, but trust is a fundamental part of this scenario. And I think some of the trust has been broken. And so people are going to latch onto that.
Social media clearly amplified what happened at Silicon Valley Bank and contributed to the very, very rapid withdrawal rate last Thursday, $42 billion in one day. My concern is that happened so fast. There are other banking institutions, very public information. There are other banking institutions that have very large percentages of their deposits in uninsured deposits. Could they be susceptible to a bank run that can be done quickly electronically without depositors actually having to physically go into the bank, so that it could happen very quickly without being visible? Does that create a new vulnerability, and does that also create a context where there could be more of a contagion effect?
We also don't know what we don't know, so we wouldn't have expected this scenario. So there may be more factual scenarios that surface that we couldn't predict, and that has a knock-on effect.
Yeah, along those lines, today in the Journal, there was a front page article about the bondholders of Credit Suisse getting wiped out, a type of bond called additional tier 1 bonds, which is a thing I'd never heard of before I read the Journal article, but apparently it's a very big deal in the financial market. And I've got to believe that market today is in turmoil because of the entire loss of the bondholders' value. So that's an illustration of the kind of things that we don't know that could be lurking out there, vulnerability in the system that only gets brought into light by circumstances. And does, that clearly makes it unpredictable. Does it lead to the possibilities of further claims?
I think just
Go ahead, Bill.
back on your previous point, Kevin. There's a difference between 2008 and today. I think one of the things, and maybe it's a slight difference at this time, but we're dealing with, or at least in the U.S., the two bank failures are banks rather than investment banks or insurance companies. So we're dealing in a more regulated fashion rather than sort of in the fringes of investment banks from back in 2008, and that all of the things that were put into effect post 2008, Dodd-Frank and whatnot, hopefully will help, and we'll actually see that some of those things come into play now and see how they do to prevent any further failures.
All three of you mentioned the possibility of FDIC as receiver type claims. And Billy, I think you underscored how difficult they can be to litigate against. I know just from my own experience, going back to the S&L crisis, and again, after the global financial crisis, there's certain substantive coverage issues that just come up every time. And I just for the benefit of the audience, think it's probably worth reviewing what some of those issues are and sort of what the state of play is. The insured versus insured issues, regulatory exclusion, there's some that just always come up. And so I'm interested, you guys are three top claims executives, what you would foresee in terms of the landscape of those types of claims disputes and where it might lead.
The first thing that comes to mind for me is interrelated wrongful acts. So you have wrongful acts that are done in year one, and then either new entrants come in to ensure that entity, or there's a renewal and there's new wrongful acts, allegedly. And so are there two insurance towers implicated, or does it relate back to one? And we saw that after the stock option backdating crisis. And we also saw that after the subprime crisis. So are we going to see that again, and particularly with the FDIC? Because some underwriters will view that as an opportunity, but how is that underwriting? Is it crisp enough to, and it depends on the jurisdiction too, but to protect that insurer from writing themselves into a claim?
Yeah, I recall the one tower or two tower fights. If I'm not mistaken, there was a big one tower, two tower fight over Lehman Brothers, and others. Are there other issues that you guys see that we can reasonably predict we're likely to have to deal with in the fallout of this current banking crisis?
I think you mentioned insured be insured, which the law on that I think remains to be not exactly crystal clear, but probably going more in one direction than the other. So I would expect, unless there's been drastic change to the language, that those things will be used. That argument will be used again this time around if it necessarily becomes a bigger banking crisis. For sure. And I think to Yera's point, we were involved in some things way back when that dealt with that interrelated wrongful act, and that insurer that came on in the second year having a, what we commonly refer to exclusion that then, sort of pits the towers against each other and whether there's coverage going forward or not. So I definitely think that those two things are likely to come up, maybe not necessarily with signature and SVB, but if it gets a little bit broader and insurers are put under a little bit more pressure in this round of bank failures, again, hoping it's only these two, but in this round of bank failures, that those arguments will definitely come back around. And look, it's been 15 years. There's lots of new judges on the bench. Maybe it's worth a try, particularly on the insured side, to test those court decisions again.
And
Chris,
also from a side A perspective, there are going to be inevitably entities that go bankrupt. And so what is the activity that we'll see from a side A perspective as well? And what are the coverage defenses that will be asserted by the insurers?
And to that point too, Yara, in, you know, if you're the lead DIC carrier and you have a primary that's relying on a primary ABC that's relying on the IBI exclusion, are you all of a sudden $1 instead of $100 million in one?
Exactly.
Chris, what are your thoughts?
Well, I think you could layer two other things over those observations from Bill and Yera. I mean, one, and this is, I think, one that I hope doesn't come to fruition, but you know, policies now have pretty commonly, on at least on the side A, they have reinstatements, and you know, when there's not enough policy proceeds to go around, and you have multiple constituents fighting to get the money, you know, people can get quite desperate and try to, you know, come up with ways to trigger more than one limit. So, you know, Yera spoke to the two tower problem, but there could also be a challenge where someone tries to make an argument that events, you know, that two sets of events that happen within that same policy year are not related somehow, and therefore trigger a reinstatement of the limits, at least on the side A part of the tower. So, you know, I don't think we saw that back in 2008. And I'm not sure that all the policies had reinstatements at that time. I haven't kept that careful track of all these policy provisions over the years, but that would be a minor concern, but at least one to keep an eye on. The other thing that I saw a little bit of back, you know, in the prior crisis, is that you wind up with two different regulators involved in the litigation. Typically, there's a parent company that's kind of a corporation. Maybe it doesn't really have any operations, and then it owns the operating company, the bank. So the operating level is regulated by the FDIC. The parent company is not really regulated, but if it goes bankrupt, then you have a bankruptcy trustee get involved. So you've got kind of two very aggressive quasi-regulatory entities that are kind of vying for the proceeds alongside, you know, the more typical litigants that we see, the plaintiff lawyers and so forth. So, you know, that's not quite a coverage issue, but it puts pressure on the carriers to the extent that they might have an obligation to figure out who gets priority among all those people vying for the limits. So, you know,
they could have that on SVB. I mean, because the holding company has declared for bankruptcy. There were other businesses operated by the holding company. There was an investment bank. There was a payment processing firm. Right. So they had real operations on the holding company side.
Right. So now they've got to sort that all out, and they have their own debts to deal with. Yeah. But, you know, one thing that's not very common in our space, but you know, if carriers recognize that they're not going to be enough proceeds to pay all the claims, you can do what's called an interpleader, and basically, you know, ask the court to sort it out for you, so that we're not in an awkward position where we know we're not going to have enough limits to keep everybody happy. If we pay them to one constituent, the other constituent might sue us for bad faith. So to avoid that liability that we all want to avoid, which is, you know, an extra contractual liability, you kind of essentially offer up your limits to the court and say, you know, you sort it out. We don't want the responsibility. Again, I don't think it's very common in our space, but it does come up every once in a while. I don't recall any cases from 2008 where I heard about an interpleader, but
nor do I. I have to say, interpleader is one of my favorite topics, and I can get really nerd out really bad on that topic. But I don't recall it used in certainly in connection with any of the failed banks, or even I litigated interpleader cases way back in the day, but not in the D&O space. So it's an interesting question. Just for a moment on the insured versus insured, just to pause there for the benefit of the audience, sort of where the state of play left off after the last round of failed banks following the global financial crisis. Several carriers tried to disclaim coverage in reliance on the insured versus insured exclusion, on the theory that the FDIC as receiver steps into the shoes of the failed bank, so in effect is the bank for insured versus insured purposes. And there are two appellate court decisions, one by the 9th and one by the 11th, where the court says, well, they step into the shoes, but the FDIC and receiver is acting in many capacities. It's serving not only on behalf of the bank itself, but also of the insurance fund, depositors, and all the regulatory interests of the United States. So it is not the equivalent of the bank, and it's ambiguous, therefore, whether the insured versus insured exclusion would preclude coverage. So that was sort of the state of play. And so that leaves an opening, I think, for further fighting this time around, especially giving possible differences in wording. I'll leave that there. I wanted to move back to picking up on something that I think both Bill and Chris alluded to, which is we could wind up in a situation where we have many claimants and not enough money. And what does that do to the dynamic? Obviously, the plaintiffs' lawyers filing the securities class action lawsuits want to advance their interests on behalf of the plaintiff class in their cases. The FDIC as receiver wants to maximize the recovery to minimize the losses to the insurance fund from the bank's failure. In both cases, they want to maximize their recovery from the fund. What impact do you think that will have on the dynamic in the resolution of these cases?
Yeah, that's a tough question. I mean, I think one scenario is maybe the savvier plaintiff lawyers on the shareholder side, might try to get in quickly and try to negotiate a relatively modest settlement, modest from my perspective or from the plaintiff's perspective, and just try to get money out before, while there's still money in the tower. And again, I think that creates a difficult decision for the carriers as to whether or not they would support that and risk problems with other constituents later on. That's at least one scenario that we might see play out. I'm not sure what other people might think. Yeah, Yera or Bill, what are your thoughts on that?
Yeah, I think it's going to be a race for the policy proceeds. And if you're sophisticated and savvy enough, you know that there's many mouths to feed. And so you want to get fed as quickly as possible. And whether that means taking a slight haircut or doing a compromise, that's what I think we'll see.
My recollection from way back when is that the FDIC just assumed that they had priority. That was just sort of, that their interest, the interest of the fund should make every other interest subordinate. I don't know if that's your guys' experience and how that might affect the dynamic.
Yeah, that was experience too. And then inevitably we learned that wasn't quite the case.
Yeah.
The, one thing that I know we saw a lot, and by we, I don't mean just Beazley, but in sort of the realm in the last bank failure, the subprime crisis, was the FDIC taking consent judgments to try to really perfect their, as best as possible, their being first in line. So going to the individual insureds that were sued and, having them sign on to a judgment, a settlement, and a consent judgment that left, really just the FDIC wouldn't go after them personally, but would go after the insurance fund. So I could see that. I do think that that's something we could see. If this is a little bit broader of a crisis, one of the things, and I think you already seen it with SVB, everybody's going to have their own lawyer on the defense side for the most part. So defense costs are going to be fast and furious right up front. And then, as regulators, whether it's the DOJ, the SEC, the FDIC files a lawsuit on top of shareholder suits, that's going to eat into policy proceeds pretty quickly. So I think Yera is right that we may see that sort of race to try to pick the insurance proceeds as quickly as possible. But it would not surprise me if the FDIC tries to pull whatever, whatever, and I don't use tricks in a pejorative sense here, but whatever tricks that they may have under federal law to kind of perfect their being first in line to get at that money. Yeah, and it's probably worth noting that there are already reports in the business media that the DOJ and SEC are investigating the collapse of SVB. So, that's very pertinent that, there could be so many multiple proceedings that start eating into the policy proceeds. And I think, Kevin, if there's one thing I would also throw out there, which is, I don't think the law is very clear on how the order of payments provisions really works. This is the provision in the policy that essentially says if you have,
B and C side claims as well as side A claims, and there's not going to be enough money to pay them all. You prioritize the side A. So, I think first of all, there's a question on timing. Like, does that mean when there are bills submitted or proposed settlements in play, you have, it's only then that you look at whether or not there's enough money, or do you have an obligation to kind of look into the future and say, wait a minute, we've got all these claims, we can't pay these defense costs that have come in now because we know we're going to have big settlements in the future. I don't think it's super clear when you have the obligation to think about that. And then the thing that really concerns me about some of the wording is that over the last, few years, I've seen a lot of the language shift from giving the CEO of the company kind of control over when to hold back on having B and C claims reimbursed to preserve the funds for a side A claim in the future. Now it kind of, in some cases, I've seen policy wording that puts that obligation on the carrier to make that decision on behalf of all the insureds, and that makes me very uncomfortable. It's just a responsibility we really shouldn't have, and that just exposes us to extra contractual liability all over the place. So we'll see if that plays out at all. But it is a bit of a concern that I think that language might impose more of a duty on us than we really want to have.
Well, and Chris, a little bit further on that point is, even if you get past the priority of payments issue, depending on what law controls, so whether it's California or New York or some other state, how do the proceeds actually get paid out in order, even if it's all side A? And if there's going to be insufficient policy limits, ultimately are the people that are also not only defendants in the shareholder suits, but defendants in an FDIC suit and being investigated by the DOJ or SEC, going to fight for a bigger share of the pot, which leads insurers into a sort of uncomfortable position, which could lead to Kevin's favorite thing, interpleader.
Yera?
It will also be interesting to see two things. One, if there will be any type of individual contribution, like we saw slightly in the stock option backdating phenomena. And then secondly, a phrase that neither you nor I, Kevin, like ESG, will plaintiffs find a way to go in and talk about woke banks, as we've heard SVB referred to, or is there any way they can tie that to make their claims a bit more salacious for the courts?
Yeah, there have been some pretty provocative op-ed pieces in the journal claiming that the reason SVB failed is because it was, a woke bank or something like that. I'll leave that to the political pundits. That's outside. I'm a D&O guy. I'm not a political guy, so I'm not gonna comment on that. I want to switch gears slightly. I think we all recognize we're only 10 days into this, and that we all know there's more to happen, but none of us can be sure what it is. But based on what's happened so far, and in particular focusing on what happened at Credit Suisse, because the Credit Suisse incident is sort of a example of how the contagion effect can spread from what seemed like something that was distinct to a Silicon Valley bank to a completely different part of the global financial system. Where do you see this going, or at least what are you worried about most about how this might play out? I think none of us have crystal balls. I'm not asking anyone to predict the future. It's sort of like, what are the things we should be watching and what are the things you're worried about?
So I would say, I think to a degree, the between Friday when SVB was closed and whether it was Sunday when the FDIC said that everything would be sort of all good, we've got your deposits, don't worry about it. My mind raced sort of about what down the line contagion claims we might see, and while that hasn't played out yet, and hopefully it won't, that is something that I have thought a lot about. And so, just using one example of, a company who has an overly large amount of their cash or cash equivalents in deposit at one bank, and that bank fails, and those deposits are uninsured. The FDIC doesn't come in and save the day. what does that lead to for that company? Probably at least a 220 records demand on some items, but certainly scrutiny from plaintiffs' law firms. So thankfully, we didn't see that, at least right now, with SVB and Sovereign because of what the FDIC did do. But I do think there is a potential, if this gets worse, and not every bank is sort of saved in the way that these two have been, that we will see the potential for that contagion going down the line, not just to public companies that have deposits there, but even potentially customers, even potentially, banks getting bought up and people getting laid off, whether that leads to EPL, wage and hour, whatever it is. There's the potential for this to sort of balloon if it gets a lot bigger than where it is right now.
And I'll go a bit more local. And for those who don't know, I sit in California in the Bay Area. So and at Hiscox, we have a much greater exposure to tech companies and biotech companies than we do to financial institutions. So I have a bit more of a concern about sort of secondary effects when you have a bank like SVB that was very specialized and catered to the tech companies, startup companies that were being funded by VC and that didn't have any profits for many years. So they had a specialization that's not going to be easy to quickly replicate. So my concern is that it's going to kind of be a dampening effect on the tech economy, which was already having some challenges before this happened. So it could kind of slow that process down and cause some kind of short-term challenges for the tech companies. And it might also lead to, there's been some speculation it could lead to some increased M&A if it really becomes more difficult for these smaller companies to manage their banking relationships, without a specialist in place. And then even more concerning for me personally, apparently SVP is also the premier bank to the wine industry. So wineries might struggle a little bit if they can't find somebody savvy enough to take over. So we'll be watching for both those disruptions.
Now
some
the audience
some on
knows
behalf of Hiscox, some on behalf of me.
Now the audience knows what they really need to be worried about. That's great. Yera, what are your thoughts?
For me, America loves community banks. And so my concern is that there are some community banks that are doing okay, but they're struggling, and this scrutiny will put them over the edge, and they'll be acquired by larger banks. And then those larger banks will inevitably be sued for their acquisition of some of these smaller banks. Was it a good decision? Was it at the right price? And so it's all of those tangential knock-on effects that end up perpetuating the crisis.
Yeah, on Bill's comment about the possibility of actions against depositors, if they're out of position when a bank fails and they lose uninsured deposits, that certainly underscores the problem that there are uninsured deposits at a lot of banks. And, there's a lot of information circulating on in the internet of which banks have significant percentages of uninsured deposits, which is one of those things that, could be a predicate for a bank run, because if they have significant uninsured deposits, those deposits could move quickly if people lose the confidence and could move quickly. That all makes me nervous. Probably the thing that worries me the most, though, is just the memory from 2008 that Bear Stearns collapsed in late March 2008, was taken over by JP Morgan, and seemingly things smoothed out. And then 6 months later, it was Lehman Brothers, a bigger bank, more exposed bank to subprime mortgages. So it's sort of the unpredictability that worries me. The very fact that we know we can't see into the future, and what does that do to depositors to motivate their conduct? What does it do to D&O insurers as they worry about how to navigate this? And I'm wondering if you guys have any thoughts about impacts on the D&O marketplace from what's already happened, what we need to be worried about, and the things that we're afraid of but don't know how to assess.
From an Inigo perspective, we write both FI and D&O. And so right now it's business as usual, but I think we're very closely watching what happens, and then we're going to have to pivot as market conditions change or as facts unfold. And we're very closely looking at it, constantly having internal conversations and thinking about where we go if X, Y, and Z happens.
I think our underwriting teams will probably dig into deeper than they already do, banking and sort of cash and where you hold your cash when underwriting, particularly maybe a new account that you're not as familiar with. So I don't see there, sitting here today with 2 bank failures out there as there being any sort of real shift. I think Yara's right that it's sort of business as usual for the moment. But with any of these things, it certainly gets underwriters to focus in on new things or things that they've always focused on, but need to focus on it in maybe a different way. And I do think that will probably start to be seen through questions submitted before those group underwriting calls.
Yeah, I think as an insurer, you always want to have diversified clients, but we also look for clients that have a diversified portfolio and diversified clients. So the key is diversification.
Chris, what are your thoughts?
Yeah, I agree with all those, and yeah, we've seen with some of our tech clients, underwriters have started to inquire about banking relationships and so forth. So I mean, I think that'll be a small piece of it. I mean, I think the thing that's very different about at the FI space versus the commercial D&O space is that the FI space is much more vulnerable to these sort of systemic issues that take out, all at once, many of your insureds. Right now, if it's only 2, as Bill and Yera have said, that's not a systemic problem. But if it goes beyond that, that could really have a huge impact on how at least FI business is underwritten, and that might bleed over a little bit into the commercial space, just to the extent that it's the same carriers that are, for the most part, writing both. And if they're going to be facing massive losses, which they're not yet, but if this escalates, they'll be facing massive losses across their whole books. Then you're going to potentially see that carry over to the commercial side as well. I mean, kind of in a weird sense of sort of trying to find a happy sub story to this bad development. We're kind of in the process at Hiscox of expanding into the FI space. So it might actually be a decent time to do that. Sometimes we're lucky in our timing, because I think by in the next few months anyway, we'll kind of know how widespread this is going to be, and then kind of getting into that space, hopefully where the rates will stay firm, and where additional capacity may be called for. That might be good timing for us on that. So fingers crossed on that. But hopefully, hopefully they'll contain it. We just have to see how it plays out.
One question. Go ahead. Sorry, Yera. Please.
I was going to say, look, I think the FI underwriters in the insurance industry are quite sophisticated and savvy. And so they know that there are cyclical systemic events that occur. And so they are always treading carefully and waiting for the next event to happen. So I think that's just part of that FI space, as if you have a property underwriter who expects, hurricanes and earthquakes. So to some extent, hopefully that FI industry is prepared and has done the right things to minimize the loss to the FI insurance industry.
Both of your comments about the cyclical business and how the susceptibility to these systemic events. A more cynical version of that is something that was told to me early in my career as a D&O underwriter, is that FI is great space. You make money every year, but then every 10 years you have to give back all your profits. And that does seem to be the way it goes. One question I've gotten over the last few days, particularly from reporters, from folks outside the industry, is, will this create sort of a hard market for bank insurance? And will change the dynamic from the softening market that we've seen? I will say that I've not seen any evidence of that yet. And what Bill and Yera said about business as usual is pretty much the message I've been getting. The other thought I have is that the reason we're in a softer market in the D&O space in general is the increasing capacity that came in during the hard market, 2019 to 2020, 2021. If there were to be tightening, I think there's enough capacity that some of that new capacity that's out there, that those players might view it as an opportunity. Maybe they might take a page out of Hiscox's book and decide this is a good time to go into FI. So I'm skeptical, at least with the evidence on the page, that we're going to see, a dramatic turning of the market for FI and certainly for the marketplace as a whole. But I'm curious to know what the three of you think.
I would agree with that, but I'm not an underwriter, so.
I think you're right. Sitting here right now with sort of a limited exposure with two banks, I think if it broadens to a significant enough degree, particularly if you have the backers of maybe some of the newer capacity in the commercial D&O market get a little skittish over, what's going on with the economy. Is this a sign of a recession? Is there maybe a pullback a little bit in that capacity? It could all change, but that's a lot of ifs. So I think for the moment, it's probably not. As a claims person for a U.S. public company D&O underwriter, I would love if the rates would firm at least a little bit or stop going down. But the market is the market, and I think unless this becomes more systemic, it probably isn't going to bleed over into the commercial D&O market too much, if at all.
Yeah, I guess the only I agree with all those comments generally. I think the only thing I would kind of throw out there is, and I had some prior experience as a broker, so I still have some sympathies every once in a while for the brokers. Not always, but every once in a while. I think it's going to be a little challenging if I were a broker doing a bank renewal over the next 4 months or so, let's say 4 to 6 months, until we know that this is really not going to spread. I think I would be very cautious about moving carriers. So I think you're going to see a lot of sort of people just trying to roll a renewal with the incumbent tower and keep everybody in line, just because it would be the claims would be extra challenging if you change carriers in the middle of what might be a sort of percolating crisis. So I think it's going to create a little bit of inertia, I guess is maybe the right word for it, on the renewals.
So we're coming up against our stop time. And so what I'm going to do is spring something on the panelists. I'm going to ask each of you to make one short prediction on, or just select one thing that you think we should be watching, you think is the most important talisman for what may lie ahead. I'll go with you first, Yera. What do you think is the thing we should be watching?
I think you have to watch what the regulators and FDIC do. I think the plaintiffs often watch what the SEC and DOJ do before they make their move. And so that is an indicia of what is to come.
Bill, what are your thoughts?
I would say, and this is always from the rosy claims guy, that is this an initial sign or a larger sign of a bigger financial downturn worldwide or in certain aspects, and sort of watching for any other traditional signs of that in the next 6 to 12 months.
Chris?
I think the part that I'm going to be watching is how this impacts what, at least in the US, what the Fed is going to do with respect to interest rates, and kind of balancing the need to avoid worsening this crisis with their still ongoing desire to sort of tackle inflation. And these are issues that are way above my head, but I think that seems to be what people are watching right now very carefully in terms of whether they'll be able to sort of do both at the same time. And then the other kind of cynical prediction I'll make is that there will be more regulation coming out of this, and it will avoid a future crisis of exactly this type, but it will miss the point, and there'll be a different crisis of a different sort just like the regulations they put in place from 2008 didn't prevent this. So, that cycle will continue.
Well, I think that brings us to the end of our time. I'd like to thank our panelists, thank Lloyd's for having us.